What is up, YouTube, and welcome back to another Fridge Financials video. In today's video, we are breaking down this advanced trading option strategy. Basically, what it's going to do is it allows us to control 100 shares without buying the stock. And what it is going to be known as is a synthetic covered call strategy. So if you are excited for today's video, make sure that you like the video, subscribe to the channel, and as always, turn on the bell notifications for all future uploads. Now, we're going to break it down with this example here of Snapchat here as a company, and I'm going to show you how this strategy essentially works. Now, it is a very advanced strategy, and there's a lot of risk that goes with it, so make sure that you do your own research and everything else. I'm not a financial advisor. None of this should be deemed financial advice. So take a company like Snapchat, for example, and you're sitting there saying, Fridge, I'm bullish on Snapchat long term. I want to buy an option in Snapchat. I want to buy a in the money Leap option. Leap, again, is looking for farther dated ones. So you go to the farthest dated expiration of January of 2027, over 1 year away. You're like, you know what, Fridge, I want to buy, say, the $5 strike price here. And basically, it's going to cost me $338. Now, as you go more in the money, it costs you a lot more money because it obviously has a better chance of being profitable, okay? Because you're buying more in the money here. But basically, this is going to give me 100 shares of Snapchat control, but only instead of buying $500 worth, I only got to pay $338 of it. In this case, $340 because Robinhood says so. So I pay $304 up front, and I have access to 100 shares of Snapchat at $5, essentially. So it offsets it with giving me a little bit of leverage. All right. Now, what you'll notice here is that Snapchat has to go up to a break even of $8.40 between now and January of 2027, and I'll be able to make any profit after that. So it goes to $8, it goes to $9, it goes to $10, wherever it can possibly go to. The profit is unlimited. But again, in case you need a little bit of a recap, the break even, how it works is that you take the strike price plus the price you pay, and together that gives you your actual truly break even. So my break even here is $8.40, and right now it's at $7.26. Looking for about a little over $8 move between now and January 2027, about a 15% move in Snapchat. Now, here's what they're saying, well, Fridge, I don't really have that much money right now in terms of cash up front. You know, I have a margin account where I have access to the cash from Robinhood, essentially, and I can use their cash if I want to, but I don't have any cash myself up front. I don't have $338 yet in order to pay for this contract, but I want to get into Snapchat here. So here's what you're able to basically do to offset your prices and to reduce your cost basis. Now, this is a strategy where you really need to understand that you are bullish on the stock, okay? If you're bearish on Snapchat, don't do this, okay? But if you have the belief in Snapchat long term, which for me, for example, I wouldn't mind it because my students use it all the time in school every single day. You know, I saw them always using it. So Snapchat doesn't seem like it's died down at all. You know, their number of customers, their number of people that are using it has gone up over time. It's just they can't find a way to make it profitable. If they can again, they'll be in a good shape. But regardless, so, you know, you're like, okay, well, I don't have $330 here. But then you're also saying, you know what? I wouldn't mind it, you know, buying shares at $5, but I don't have the cash for it right now. So what you could do is you could do what's called a sell a put option, which is basically a cash secured put. Now, basically what's going to be happening here as a result of this is that selling a put option means you don't mind buying the stock at a certain strike price. So say you want to now sell a $5 put option here. What you have is when you sell a put option is you get paid a premium upfront of $77. So what happens in this position here? Well, take a look at what happens here. You bought the $5 call option for January of 27. You also sold the same strike price put option for January 27, and look at what happens as a result. Your break even went from $8.40 down to $7.61. It was over 15%. Now I need Snapchat to move 5% up, and that's it. So it went from a 15, almost 16% move to break even to now only having about a 5% move to break even as a result. Okay, so that's what's really, really fascinating about this kind of idea here is that you're able to essentially, you know, offset your cost basis on the Leap option. Now, what happens here is that if you go to continue and you wanted to do this time the market is closed, so you can't do it right now. But if you want to go buy this option here, for example, you hit review order, you will have to also have collateral aside. Obviously, if you had the cash up front, just buy the call option. Okay, and I completely understand that. But if you don't have the cash up front to just be able to pay for just the call option here, or you want to offset it a little bit, but you have access to margin. So for me, like Robinhood says, hey, you have X amount of money on margin here. Basically, what will happen is that they'll take that money and put it into options collateral for you on your behalf. Now, I'm basically using Robinhood's margin, what they are allowed to give to me, to basically offset my cost basis of my call option. And then if Snapchat goes on to $5, I don't mind owning it for $500 here. If I get exercised at $5 for Snapchat, then I'm using their cash for it. Then I start getting paid interest. They have to start paying interest on top of that in this case. But for right now, again, as long as it doesn't come down, that huge percent from $7 to $5, this will expire worthless over time. And hopefully this call option becomes worth more and we can profit as a result. And what you're going to look at here is, let me go back here. Again, what's going to be happening as you're doing this kind of trade here, and I can show you how the math works here a little bit more, is that if you take a look, your max loss is $340, basically what you pay for the option here. But if you sell the call option, it's going to actually push your max loss up higher, because say Snapchat goes to zero, you not only lose the call option, but you also lose the $500 because you bought them at $500. You bought the shares for $500, and now it's down to zero. You lost all the $500. All right. So this is what's basically it's called a synthetic long in this case here. So it's a synthetic long here because what basically happens is that you have basically ownership of 100 shares here, but you're offsetting the cost basis as a result. So you basically are moving 1-to-1 with that stock, because as the stock is going to move up, your call option becomes worth more. Your put option that you sold loses value. So this gives you more cash. This gives you more cash. So as long as the stock moves higher and higher, you can make a lot of profit as a result. And if you take a look here, remember that $8.40 break-even price for this kind of trade here? Now you're looking at $8.40. Now you're already up $80 and it costs you $261. You're looking at almost a little over a 30% or almost a little over, about 30% return on your investment. Instead of break even at $8.40, you're now up 30% because of the synthetic long here. And again, it does cost more, but remember, if you have margin from Robinhood, you can use their margin to offset it. You're selling a cash secured put. Again, if you're bullish on companies, there's nothing wrong with selling cash secured puts. You just get in at cheaper prices. Because say I get in at Snapchat at $5 a share, okay, cool. It runs up to $10. I could double my money and so on and so on and so forth, right? There's a lot of things behind the scenes for it. But this is called a synthetic long, all right? Because as the stock moves up, the call option becomes worth more. The put option becomes worth less. You basically double dip and get a lot of that money as a result. And as it goes down, obviously what's going to happen, the call option goes down. The put option loses value or gains more value. So you lose the cash as a result. So it moves down with the stock. Okay, so again, basically it's called a synthetic long. Now, I said at the beginning, this is a synthetic covered call. So this kind of ties back into my idea of basically poor man's covered calls, but almost on steroids now. Okay, because the poor man's covered call basically says, hey, buy a leap option and then sell shorter term call options against it to get passive income. Now I'm buying a leap option, I'm selling a put option, and I'm also going to offset and get income from selling covered calls again. Because if I sell a call option now, this is going to be my collateral for that option here. So it's still a leap option, but this put option is there to help offset this call option. And if I sell call options, it also is going to help me offset profit as a result. So say, for example, I sell, an $8 strike price for September 20th. What's going to be happening here is that you basically are going to be capping out your losses at that $8 strike. But look at this. If it goes to $8 between now and September 26th, so about 20 days out here, you make $80 and it costs you $240-something. That's 30% in just a month. Because what will happen, say it goes to $8, what's going to happen is this gets exercised. This gives you a little bit of value still. And then this becomes exercised, and this $5 call option fills the $8 call option, what's happening here. So it's a lot of moving parts here, but it really does allow you to capitalize on these kind of gains. I'll give you another example that I did some really good with so far. It was SoundHound AI. Now, I didn't expect SoundHound to pump up this high at the time of me recording this. It went up 7%. I got in because I'm bullish on SoundHound overall. And what you'll notice is that I do have a synthetic long option right here. So I bought a $10 call option. I sold the same $10 put option here. And instead of paying $700 for it, I only paid $356. Or let me see here. Instead of paying let me see. Instead of paying $600 for it, I only paid $356 because the put option premium offsetted the call option. And since it went up 7%, which is absolutely unbelievable, I didn't think it was going to do that, I'm already up $95 on this trade here. I'm already up $95 already. Absolutely amazing. Okay. My break even is $13.56 and we are way past it already. This is for January of 2027. Again, I'm bullish on SoundHound AI long term. Some people are saying, oh, like a price point of $20 is a potential here. And if it goes to $20, look at the percent returns we're gaining here between now and January. Even if it goes till expiration, I'm up 181% potentially if it goes down to $20 a share. It's got good software. It's got major partners. I'm bullish on SoundHound AI here. But watch what I'm able to do here. So let me pull up the option I bought here for you guys. So I did the $10 call option. Then I sold the $10 put option here. And now, so say I want to go to September 26th. I want to sell a call option to basically be a poor man's covered call on my $10 leap option here. Say I want to go to, say, I don't know, $16. $16, I make $238, and it's going to cost me $394. But again, the thing to keep in mind about, you have to be bullish on the stock for this to work. Another one I have is Archer Aviation. Archer Aviation is another one that I have here. So what I have is, again, a debit spread here. Again, I did a $7 leap call option. I did a $7 cash to carry put option here. So I have $700 here in collateral, and I bought this one. But instead of me paying for the call option of $356, I only paid $185 because I got offset with this price right here from my sold option. Now let's build this one out here and take a look at what happens here. So I did the $7 call options here for all the way out to January. So I bought this one, and I sold this guy. Boom, boom. All right. So what we're looking at now, again, is about $190 cost basis right now. And again, my break even is if Archer goes up to $892 between now and January 2027, I'm break even. It has climbed as high as I think like $10 to $11 a share. If it goes up to even, $10 a share right here, like we're making a lot of money. Look at that. We're already up, $90 or so. We'd be looking at close to, $100. Look at almost, 50, 60, 70% gains right here. Now, in the meantime, again, if I wanted to sell a covered call option against it, say I wanted to sell a $9 option here, again, that's going to cap my upside potential, but take a look at the income I'm getting here. I'm paying $159 and I make $87. You're looking at over 50% returns in just about a month. Not even a month. You know what? Let's do a month. Why not? Fridge Financials here. October 10th, $9. You are making $102 on $143. You're making almost 100% returns by doing a synthetic long, poor man's covered call. I know it sounds made up, but it's not. Now, there are risks to this, right? If Archer Aviation goes down and I get assigned, I got to pay for my shares. My $700 goes in for it, right? So I believe, I don't know if I can take a look and see here. Let's explore the margin here that we're looking at in this case here. Margin just calculated. Okay, view all rates. Here we go. So I'm definitely not, I'm at 5.75% right now. If I get assigned Robinhood shares, if I get assigned shares of a stock at, using Robinhood's margin here, for example, take Grab Holdings for $4.50, as long as I can make over as long as I can make basically 6% more between that time and the next year, I can pay off my interest while the stock does what I want it to do. So if I want to sell a call option, a covered call against my shares that I got forced to buy on their margin, if I want to sell a covered call, as long as my covered call offsets my 6% interest rate, then I'm good no matter what. So it's really, really nice in this case here for that reason. Now, right now, again, I was to make sure I'm at low risk here in this case. I still have some margin available, but I'm not going to touch it whatsoever because I'm getting really close to my buffer here. So I don't want to touch that right now. But again, what you'll see here is in my options chain, grab holdings. I'll be looking at covered calls at some point and selling a call option to offset it. BayBear AI, I have one. I already did one. Now I have another one that's going to be offsetting it even more. Snapchat, I believe I did one for $8. Yep, it's going to offset it a little bit there, which is good. Archer Aviation, I have not done it for yet, and SoundHound AI, I have not. But SoundHound, I definitely will because those premiums are going to be juiced. They went up 7%. It went up 6% today. So I'm kind of bummed out that I didn't sell a covered call here, but hopefully Monday morning when it opens up, if it's at least flat, I can hopefully sell a covered call to kind of offset my cost basis as a result as well. So thank you guys so much for watching today's video. Again, the name of the strategy is a synthetic long poor man's covered call strategy. Very advanced, not for the lighthearted here, but if you know how to manage, you work on management, you have time to manage these kind of trades here, definitely could be very, very good for you long term. So thank you guys so much for watching. Again, if you made this fun the video, make sure that you like the video, subscribe to the channel, and turn on those bell notifications as per usual. I always will hope you guys are making money in the market in some way, shape, or form. And as always, I will see you guys in the next video.